Hey everyone, welcome back to Move Me to Pittsburgh, the show where we break down Pittsburgh real estate, local stories, and the conversations shaping life around the city.
We're your hosts, David and Cassie. Whether you're tuning in for market insight, neighborhood talk, or a fresh take on what's happening around Pittsburgh, we're glad you're here.
This week, we're talking with our lending professional, our in-house lending professional, Amber Housholder. We're going to have her on here in a few minutes. But we're also going to talk about some headlines that are catching our attention and the things buyers and sellers are talking about right now.
Yeah. So settle in. We've got a great episode lined up today. Let's get into it.
Awesome. So I'm super excited. Cassie just got out of a closing and bam, right on the microphone.
Yeah. Congratulations to my buyers on their brand new first home.
Oh, that's super exciting. Where did they buy?
Swissvale.
Swissvale. Nice.
Yeah.
That's one neighborhood we have not jumped into and talked about yet.
We have not.
Although you were in a coffee shop there the other day, didn't you tell me you were?
Oh, I was. Yeah. Like that Parisi Cafe and Italian Market or something, I believe it was called. It was really good.
Yeah, cool. I still have not tried that out. If you go to Cassie's Instagram, I believe she posted a photo of it.
I did.
Cool. So we are a little bit behind schedule. So let's get our guest in here.
Absolutely. All right. Hi, Amber.
Hi, everybody.
Yeah, Amber. Thanks for joining us today.
Awesome.
Sunshiny in the office.
Yeah.
Coming to us from the office. Awesome. Well, Amber, can you tell us a little bit about yourself?
I've been in the mortgage business longer than I want to say. I decided this morning I was going to say over a couple dozen years instead of the actual. So, and I have been in real estate since college. So, yeah, I've been floating around this industry for a long time.
Wow. So you came immediately and got into real estate.
Yeah, I did my internship at a Century 21 office and then moved to mortgage from that. So it's been like my entire career has been in real estate.
No kidding. Wow.
Yeah.
See, everyone's got experience.
That's cool.
Yeah, so I feel like I'm a little grounded in the real estate department.
Yeah. And at one time, I think, what neighborhood do you live in?
I live in Southside, and I've been there like 18 or 19 years. So,
wow,
that's awesome.
I'm down in the city.
Yeah, are you in the flats down there?
Mm-hmm. I am.
Oh, that's cool. I still to this day I think Pittsburgh's my favorite, or excuse me, Southside is one of my favorite neighborhoods. Cassie, I think you were on Mount Washington. I was on Mount Washington 9 years. So guess where the first place you go every time you want to do something? Southside Flat.
Exactly. So can't figure out where to go otherwise, right?
Yeah. What made you pick Southside 19 years ago?
Got divorced, kept going to the city instead of, I grew up in the north, so I kept going to the city, driving home, not a good plan. So I had friends in Southside, found my place down there, and now I'm like the lone survivor. But I like it, and I just haven't found a better place to be.
Yeah. Oh, that's cool.
There you have it, Southside.
Yeah, cool. So you've been in this game 19 years. You're with Guaranteed Rate Affinity, right?
Yes.
Yeah. Cassie, tell me something.
Yeah, we love Amber. We love Guaranteed Rate Affinity. My fiance used her when he bought our first home. So I can speak from experience that it was a great process. Amber was amazing through all of it. So highly, highly recommend.
Yeah, so there's no better than having firsthand experience of working with you.
Yeah,
sure.
What are you seeing, Amber, right now as far as like the first question that a buyer comes to you and asks?
Mostly it's about interest rates. Probably second question is about down payment, like either how low of a down payment or how high of a down payment. So it's like both end of the spectrums. And there's reasons maybe to do 20% down, 25% down. And then it does depend on the area, but, it can be a 3% down payment, 3.5. And in the rural areas, there's a program for 0 down. So those are usually, I think third question behind that is talking about credit. If they have really excellent credit, or maybe they have credit bumps, they just want to know how that's going to affect them and what it means in this process. So we kind of talk through those things when we're working on pre-approval. But those seem to be the top 3 questions.
Yeah, rates are number one. That's the first thing that we get hit with. Do you think people are nervous about reaching out to a lender?
I think they have concerns when they first talk to someone. Sometimes it's around pulling credit. So whether someone's doing a hard pull or soft pull, I think over the last 12 months, maybe a little longer, we've been able to do soft pulls. So we can do the pre-approval without hitting on their credit, which makes people comfortable. And yes, they're scared sometimes. They don't want to know the answer. It's like going to the doctor when you think you're sick. If they think they have, a bump, then, just it's kind of scary. But if we can know, what their concerns are, I can kind of lead them like, this is how we get over it and move forward. Maybe it takes some time, or, this is like a really difficult hurdle and you're going to have to do this, that, and the other thing. So try to, just move them forward, but sometimes they just don't know what's going on, how bad it is. And mostly it's definitely easy things to overcome.
Yeah. What I see as far as it being a little bit intimidating to reach out and show your entire financials. It's something you guys you kind of have to, which is why we wanted to bring you on to like it. Most people, I don't know if they picture like a suit and a tie, somebody sitting there and they're just like counting cash in a bank. Like we're humans, right? You guys, you're right. Human. You're gonna ask them their situation before just immediately. Okay, you're no good. We're just gonna toss you to the curb if you don't hit the exact debt to income, or you don't have the exact credit. Look, they're gonna have a conversation with you and hear your story before just immediately approving you or denying you. So that's one of the biggest things is
getting the whole story. Yeah, getting the whole story is always important because there can be just different reasons for different things, and there are a lot of options. So you kind of have to lead someone through figuring out, okay, because of this, we have to move here, maybe, and because of that, we have to move here. So you're like trying to prune it down to what would work for them and then explaining how it could work. So whether it's going like with a conventional loan or maybe using the government backed loans like FHA, or if someone's a veteran, the VA. So, it just kind of leads you down one of the paths. Sometimes people can do several things. Sometimes there's only like 1 or 2 ways to do it. And then you just, if they're comfortable with the results and what their mortgage would look like going those directions.
Yeah. And do you, as far as when a buyer gets sent to you right now, other than rates, or would you say there's a percentage on the amount of people that you approve?
Yeah, I think it's a pretty high percentage. I would say, probably 8 out of 10 people I approve.
80%, yeah.
But the two other people, I put them in my calendar. We make a plan of how to make them, part of, getting the approval if it's possible and they want to do it. So sometimes I probably have a big group of people now where we're, looking at their credit scores at the beginning of every month, seeing if they've improved and trying to put them, into a program.
Yeah. So staying in contact and working with them, like not just dropping them
Yeah.
because they might not approve right now.
No.
Yeah,
Yeah,
that's
because
great.
they'll be, maybe they're the future 2026 person
Yeah.
who's going to buy a home, but we need them to improve their credit score or open new credit. Sometimes people don't have any credit open, which
Okay.
some people think is good, and it's a choice. When you're doing mortgage financing, it's not so great sometimes because it doesn't give you a score if you don't use credit. And when
Right.
you want mortgage financing, they want to know you can pay your bill, whether it's a credit card or a mortgage or a car. So sometimes it's stuff like that. Or some people are new, like just leaving college, and they maybe haven't had a lot of credit, so like they need to establish credit. So I suggest getting to be like an authorized user on parents cards. That helps build credit quickly, and just different things. You have to understand what they're doing, and kind of what circle like we can tap into if there's extra help.
Yeah. To back it up, and this is another probably misconception that a lot of buyers have. Can we talk about that a little bit? 20% down. I heard
Yeah.
you mention it a little bit. Let's assume
Yes.
we're a first-time home buyer and we don't eat, sleep, and breathe real estate every day.
Yeah.
And I came to you. Most people think they have to put 20% down. Can you tell us a
Yeah.
little bit about that?
So I think the 20% down amount comes about when you're talking about mortgage insurance. So the way it works is if you put 20% down or more and you're on a conventional loan, you don't have to carry mortgage insurance. You can put less than 20% down, but you do have to carry a monthly mortgage insurance. And what mortgage insurance is basically a policy against you not making your monthly mortgage payment. So if you want to put 10% down, there's a private mortgage insurance policy we can get for you. If you want to put 5% down, there's a policy you can get, but they're not equal. So the more money you put down, the lower the monthly premium is. And when you get to like 3% down or 3.5% down, that's when you have the highest mortgage insurance. So it needs to be a part of your monthly mortgage payment and your monthly mortgage budget. So if you have a target, we need to account for that amount, but you could definitely put less than 20% down. We just have to add in that PMI element is another way it gets. PMI, private mortgage insurance, those are all referencing the same thing.
Right.
Okay. So as far as the PMI, is that set by the government?
It is not. So there's private mortgage insurance companies. And whenever I'm pre-approving someone, I think we have 8 or 10. So we just bounce out to all of them and see who has the best coverage amount and the lowest monthly cost for us. And then we can, pull that in for our estimates. So it is based on how much you have down, what your credit score is, and the program that we're using, and then we'll be able to know like what the mortgage insurance factor would be for that particular customer.
Beautiful. Okay. All right. So you guys broker it out and find
Yeah.
them the lowest rate on the PMI insurance.
Yeah, like I
Okay.
think you probably heard of like MGIC or Essent or National. Like those are some of our mortgage insurance companies. So then when just to take it one step further, so working on the pre-approval, I'll work on the cost sheet and the numbers so the customers can see like at this price point, here's what your monthly payment would be with estimated homeowners insurance, your private mortgage insurance, estimated taxes for the area that you're interested in, and then principal and interest. So we're kind of giving them that full payment picture, which when they find a house that they want to make an offer on, I always ask, send me the address. I'll give you a more drilled in monthly payment.
Yeah.
With like the actual taxes, because sometimes those can fluctuate a lot.
Right.
Absolutely.
Okay. So as far as we talked, if you don't put at least 20% down, you will have that extra insurance policy in place. What is the lowest that a buyer could go with a down payment right now?
So in rural areas, I know like that might not be our target areas all the time, but rural areas, it can be 0 down. Probably the next threshold is 3% down conventional, and
Wow.
FHA is 3.5% down.
Wow. Okay. Do you hear that, people? You can go as low as 3% down. And if you're in rural, would that still be a conventional product? Or would that take you into USDA?
It's USDA, so it'll act like VA and FHA, but it's still, if you can qualify, 0 down, seller's assistance, it can be a low cost out of pocket program that you're not a veteran.
Okay. Cassie, have you ever done a USDA loan or had a buyer that did one?
I did. Yeah, I think
Really?
I had one so far, right? I had a buyer that had it. I remember. Yeah.
I think it was Eloquipa, right?
Yeah. Like towards that, like Ambridge area. Yeah, I think.
Mhm.
Okay.
Yeah.
So about 45 minutes up the river.
Yeah.
Okay. Is that
And
regulated
south.
on the amount of land, or how does that qualify?
Yes. So, like, of course, city of Pittsburgh wouldn't work, but when you get into Beaver County and you're real close to the river, those areas don't qualify. But when you come like one, step out from the river, or if you go, south into Westmoreland, certain parts of, Washington County, you'll start picking up USDA. If you go north into Butler County, like parts of Zillionople are USDA, and further north. I don't do very much east, but I mean, that would be
Go out there.
eligible. Yeah.
Understood. Okay.
Yeah.
Yeah. So we can go as low as 3% down. You get that PMI. Tell me a little bit about like the FHA. It is known as like the first time home buyer program. Can you tell me a little bit about that?
Yeah. FHA is an awesome program. In the past, it's sort of gotten a little bit of a bad rap. The program allows for 3.5% down. It has probably better rates than conventional. And it also has a set monthly mortgage insurance factor. So everybody on FHA gets the same factor, so you know what it is. The reason people might use FHA is for down payment reasons. They also allow 6% of purchase price for the seller to contribute help to the buyer's closing costs. So seller concession, seller assistance is 6% on FHA, which is attractive. It's the highest amount that you can get for help. The other thing that FHA does is if you have credit bumps or credit difficulties, or you've had credit events like bankruptcies, foreclosures, and things like that, FHA is the program that has the shortest waiting period. So there's a bunch of things FHA does that maybe conventional wouldn't do. And, they can be fast. It doesn't have to be long drawn out closing times. So those are all the good positives. Some of the negatives that you might think of for FHA, the house has to meet certain standards that FHA has. So we rely on the appraiser to go out. So you have to be a certified FHA appraiser, and they go out to look at all the standards of the house. So when they're doing the value, they're also looking at all the things in the property. So some of the main things that get chosen to be corrected for FHA are lead-based paint hazards. So if the property could have lead-based paint, it would be, needed to be fixed. And you fix lead-based paint by scraping off the paint and repainting it. The chip is actually the hazard, so you have to make sure the chips are picked up. The GFI outlets in the kitchens and the bathrooms. And I've had a couple recently where they make it by the washing machine. So if the property doesn't have GFI outlets, or it has an old electrical, you might have to get those upgraded. And the other main thing that I find, especially on the deals I work with, are stairs. More than 3 stairs in a row needs to have a handrail. So that could be attic stairs, basement stairs. It could be outside stairs. So like those are like the top 3 things that come in for FHA repairs. So sometimes that is viewed as not a positive, because those things would have to be repaired or fixed or installed, and then we have to send the appraiser back out before you can close. So for the most part, you can't escrow for those things. You can't say, I'll do them after closing. You kind of have to have a meeting of the minds before closing. It needs done, and then we have to check and make sure it's done. The only other kind of prickly thing about FHA is with the mortgage insurance, if you're set up with a 3.5% down, you do carry the mortgage insurance throughout the life of the loan. So that's different for the conventional loan, where if you hit your 20% equity on conventional, the MI goes away. For conventional, it hangs around. But I could show you, we could do payment schedules. If you're doing 3 or 5% down conventional and you're doing 3.5% down FHA, if you go like 5 years and 10 years into the future, you're almost in an equal spot. So if the house is someplace that's going to be your timetable for living in it, FHA isn't going to hurt you. You're going to be in, the same, almost same financial boat. So I still think it's a really good option.
I have a lot of buyers that I think one of the biggest, when they hear about the different types of loans, they ask, what's the best way to determine which one I should go for? Like, how do you help them choose what's best?
Sort of. So when the mortgage qualifications, a big thing is credit and credit scores. Second big thing is debt to income. And third would be like, how much do they have for down payment and closing costs? So if we have someone who has maybe not so great credit and not a lot of money to work with, it would probably put us in the FHA path, because you can, the mortgage insurance, you can get seller's assist. That's going to get them where they want to be. If we have some financial options and good credit, we can show them both programs and they can choose which one they think would be best for them. Mm-hmm. Sometimes it takes till you find the house, maybe, right. They want to use FHA. They find a house that won't even have an FHA repair. It's perfect. We go that route because the interest rate's better or something like that. So you kind of have to show them several options. And then once you find the house, you can maybe say which option might need to be replaced, or this one's better than that one because right. of something.
Yeah. Okay.
Yeah. And most municipalities right now are doing occupancy permits that the seller has to take care of, unless you're buying an as-is home. Most of the time, those exact inspections are what an FHA appraiser is going to be flagging. So I think a lot of people get very nervous about having that extra inspection done, and it's just not as vigorous as what some people might believe.
Exactly.
Yeah, I heard you mention it a little bit, and this is one of the biggest things that I think about with the FHA is that PMI is on there for the life of the loan. With those rates being as low as they were at one time, we hopefully will never see them again, but the rates do fluctuate. And the other thing people I don't believe think about is the appreciation. We're going to start seeing a lot more of it, I believe personally at least. That's where you really have to think about, as that property appreciates, you're also, what do they say, 17 years if there's no appreciation that it takes to get 20% paid down. Does that sound about right? It's over
I think so.
10 years, right?
Yeah. I haven't done that calculation in a while, but yeah, I think you're on the right path. If there's no appreciation and you look, it takes you that long to get that far into your amortization over the 30-year period. Yes.
Yeah, so it's over 10 years just to take that into consideration. So you'll have that on the life of the loan. I think we did, just Cassie, your home that you bought is already, the loan to value is over that. You've got 20% of equity, and it's only been 3 years.
Yeah.
So it's crazy how fast things are appreciating, and we are still in a very conservative market. We have not seen like an Austin, Texas style boost, which keeps our market healthy, right?
Right.
So talk a little bit about that seller's assist. What does that mean?
So when you're purchasing a house, you have to consider two things. You have your down payment. So whatever that amount is, like we've talked today, could be as low as 3%, and onward and upward. But you also have closing costs, and sometimes people don't understand how much closing costs are, and it does depend on the area that you're purchasing in, but and the price point that you're purchasing in. But closing costs can be 4 to 7% of your sale price, so it's not a little amount. So sometimes people have saved their down payment, but maybe they don't have all their closing costs saved, or they have a part of them saved. So you can negotiate with the seller to pay some of your closing costs. Different programs set limits on how much the seller can contribute to your costs. So for FHA that we spoke about, and VA and USDA, so the government programs, you can ask for 6% of sale price to be paid towards your closing costs. So if you're doing a $100,000 purchase, you can ask for $6,000 to be paid towards your costs. The tricky part is those funds come directly from the seller's bottom line. So if you're asking them to pay $6,000 towards your closing costs, they're taking $6,000 out of their pocket and they're putting it towards your costs. So if you're making an offer of $100,000 and you're asking them to pay $6,000, really your offer is $94,000. So sometimes we go, 106 with $6,000 back. Essentially, seller's assist is seller paying money towards your costs. Conventionally, there are some limits. So anywhere from 3 to 10% down, conventionally, the seller can only pay 3% towards your closing costs. Once you put more than 10% down, they can then go to 6% of sale price towards your closing costs. So it does have to be on your contract. So we can talk about it as the pre-approval, like, hey, you need to negotiate your seller's assist, or I will include this number on your estimated cost sheet. But it would come down to, like, if they're working with you, David, and you're making an offer, it needs to be on their contract. The seller has to accept it for it to be money that comes to them.
Mm-hmm.
But it completely just offsets what their closing costs are. It's a direct, like, their closing costs are $10,000, they get $6,000 seller's assist, then they have $4,000 left and their down payment, and that's what the cash needed to close would be.
Yeah. And on this, for sellers that are possibly listening to this, the key thing there was that they can go above and then ask for that seller's assist. You just have to focus on what your net amount is. It doesn't matter how much assist they're getting, as long as your net remains the same. So if they go up minus the 6, you're still netting that 100,000.
Yes.
And it is very common. Do you see it in the past year here? Let's say last 6 months. Are you seeing more sellers assist and more creative styles
Always.
of financing?
Yes.
It's becoming
Yes.
way more popular again.
I'd say half the contracts come in with seller's assist. Sorry.
Yeah, over 50%. I would say it's, Cassie, did you have seller's assist on yours today?
Yes, we did.
Yes, right? So don't be afraid to ask it. That is the key there. You're getting it. It's less amount that you have to come to closing. Because Amber, if you would ask for a reduction in price, do you think that would be a better decision, to ask for a reduction or ask for seller's assist?
It depends. It depends on what the goal is. If you're trying to make their cash out of pocket lower, you want the seller's assist, because if they lower the sell price, yes, they're paying less for the house, but in their estimated cost sheet, it only changes it like a couple $100s. So if they're getting $6,000, or they're just lowering what their closing costs are, most buyers will want the seller assistance, or that's what's impacting them at closing the most. So that's the direction they want to go. You can do both, or you can do one or the other, but usually it's the seller assist that they want to lower their cash at close.
Yeah, I love that. I love the creative things that can go on behind the scenes. Can you give us an example of a recent client that you worked with that you did something creative to secure the deal?
Sure. So I think of two things. The first is on conventional financing. With someone getting seller's assistance, they were putting the 3% down, but they really just needed a little more help. So they negotiated with the seller to pay all the transfer taxes on the transaction.
Yep.
So in Pennsylvania, it's typical for buyers and sellers to split the transfer stamps. For this contract, the seller paid all and offered the seller's assistance. So it took the buyer's closing costs low enough to where they could, handle it and make all the numbers work. So that was a conventional suggestion. And then the other was FHA. And we did have 6% seller's assist, but it was in the city of Pittsburgh. So we utilized a city of Pittsburgh grant program and had them apply and get the grant. So they got $7,500 towards their closing costs in down payment. So that's not possible in every area, but if you're in the city of Pittsburgh schools, then you could probably, it does depend on income, but if someone qualifies, it's an awesome program to pull in and utilize.
Yeah. I've used that for multiple buyers.
Yeah.
And do you remember what the name of that program was called?
It's the URA, down payment closing cost assistance program.
Wow,
so
beautiful. Okay.
Yep. They have a couple levels. They have a $5,000 level and $7,500, but it's based on like what your income is versus the AMI in Pittsburgh.
And Amber, correct me if I'm wrong. Not all lenders are willing to work with these local groups like this, correct?
Yes.
And you are one of them, obviously, that works with these groups.
Right.
Yeah.
I did PHFA see also, too. I'm sorry, David.
I was going to say there's also a list that I saw the other day that had your name, your company name on it that does a bunch of different ones. Can you tell us about those?
Yeah. So now, I mean, there are some local banks that we don't work with, like they have some special programs, but for Pennsylvania State Bond, which is a state-backed program, it's a mirror of the regular FHA, VA, and conventional, but Pennsylvania State backs the interest rates, so they offer lower interest rates for customers, and they offer those, it's either second mortgage or down payment and closing cost assistance programs. So if you can qualify for PHFA, it's an awesome, way to go because the interest rates are lower, and there are seconds or grants to have, but there are income and credit limits. So sometimes if you're in the income bracket and your credit's not high enough, so if someone fits the building blocks for it, then immediately go there because the interest rates are attractive for the PHFA. So, and we have a handful of national programs that work the same way. PHFA is probably the most attractive rate wise, and then we can ripple out to the others if needed.
Okay. There was one that was also like a K-Fit. Is that one of the ones that you mentioned?
K-Fit marries with one of the PHFA first, so it's a second. So you do a first and a second. Second's called K-Fit, and so you do have the income limits based on family size and the credit scores.
Okay.
For the K-Fit.
Are typically those extra programs, the PHFA, the K-Fit, the one you mentioned with the Urban Redevelopment Authority, are those pretty much for first-time home buyers only?
Yes.
Yeah. Okay. Yeah. So
the
if you
URA
are a first-time
doesn't.
home buyers,
URA doesn't have to be first-time home buyer, but PHFA does.
Absolutely has to be. Okay. Got
Yeah.
it. Yeah. And why do you think, Amber, that most that some of these big national lenders won't work with those groups?
They don't have the local presence. So there's, like if I had to, I can go to the URA office, I really went on a drive to Harrisburg, but I can get a hold of PHFA, pretty easily. So it's logistics sometimes, and then, sometimes people are doing things not for the best reason. Sometimes some banks have to offer things because they've not been good and this is their punishment. So they have to do some of these programs. So they're not letting anyone else do them. They're just doing them themselves. So there's a couple of different reasons, but yeah. So being local in the area, then you kind of have your feet on the ground and know what's going on and can maybe show up at a doorstep somewhere.
Yeah.
Yeah.
It's very meaningful to have a lender that's in arm's length that you can talk to as well. And then also a lender that's in this geographic area that knows these different groups that you can just immediately go to. So it's extremely helpful. The next thing I want to transition into is affordability. That's one of the biggest things right now, especially being an election year, that's getting talked about. Some of these programs that you mentioned, I know a lot of, I don't know, millennials, Gen X are like kind of tapping out of the wanting to even own a home.
Right.
They're building these micro apartments all over the city. They're extremely competitive. You can get into them. You have a bunch of amenities, pools, and you're in distance to other people your age that you can hang out with. Like, what I want to transition to is like construction loans. Do you do those?
Yes.
Yeah. So we talked about this, Cassie and I, in a previous episode on homes that need a little bit of extra work.
Oh yeah. Well, there's two paths. Those are two questions. So there is new construction financing where you're buying earth, you're buying land, and you're building a house. So that's like what they call that construction to perm, maybe, and it will be called new construction. But then you could also have a house that's sitting there. It needs tender loving care, or it's not that pretty, or there's structural something here or there. And it's an awesome location. You would never want to tear it down. So there's renovation loans or rehab loans that you can do. So the new construction is like you're building something, you have, a builder constructing, but reno is something is there. And what you have to work on is someone who can give you a quote on all the things that you want to have done. So you do need plans and specs. Depending on what you're having done, that can be relatively easy if they're easy repairs. It could be very difficult, like it could be extensive, like $100,000-$200,000 worth of renovation. But what happens is you can buy the house, and what you're purchasing what the house cost is and how much the builder or contractor is going to do to your house. So you put those two things together. So maybe you're buying a $150,000 house. You're putting $100,000 into it, so you have financially $250,000 in, but maybe it's worth $300,000 or $400,000 when you're done, just because you did all of these. You updated the bathroom, you updated the kitchen, you put a pretty front porch on and added a garage or something like that. So those loans are definitely out there. They can be conventional, they can be FHA. 203K is the name that most people recognize, and that's the FHA renovation loan, 203K. So
is it harder to qualify for these loans? How does that?
No, it has the same guidelines. I think the hardest part that I've found is getting the contractor and the contractor's bid in the time frame that everybody needs. Like everyone thinks that's a fast thing, and it's not. Having a builder or a contractor come out and say, we'll do all this work, here's what it's going to cost. It's a few week process.
Okay.
But if you qualify for FHA regular, you would qualify for FHA renovation. As long as the numbers work, it would be the same boat. Seller's assist, mortgage insurance, all that happy stuff.
Okay.
Okay. So that there's a differentiation between construction loans and renovation loans. That's the
Correct.
big thing, right? Okay.
Yes.
So if somebody said let's say that they found a $100,000 house, it needs about $50,000 in renovation, but the after repair value on this particular property is $250,000.
Yeah.
What would you recommend them?
Renovation, definitely. We would,
Renovation, right?
work on, like, my question would be, can you get a contractor to the house to, ensure that that 50,000 is going to take care of what you need it to take care of? And then, like, would you be happy with that? And then we pre-approve them on the as complete on the 150. The down payment is based on 150. And then you actually have a closing. It becomes their house, and then the contractor comes in and does all their work. But the appraiser and everything has to look at the plans and specs, and you'll visit the house as it's standing and verify that the house will be worth like the 150 at least after all those repairs are completed.
Mm-hmm.
So
And there's something scary in there that I heard, like specs and look at the renderings and things like that. How particular do they have to get on those renovation loans?
you have to, like, if you're submitting plans and specs and saying you're putting hardwood floor in, you have to put in hardwood floor. You can't switch it off and do carpet. Those are two different values. Or, if you're renovating 2 bathrooms in the kitchen and then you decide, you're only doing the 1 bathroom and part of the kitchen or something, like, those are, you have to kind of do what you're planning on doing. What usually happens is you're planning on doing 2 bathrooms in a kitchen and something else creeps up that you weren't planning on that you still have to fix. Maybe it's electrical, maybe it's water, something like that. So in renovation financing, there's usually, sugar, I'm forgetting the name. It's a pocket of extra money that they hold back. So if you do find, things that need extra funds, so you needed 150, but let's plan on 160 in case you find something else that you need money for. If you use it, you can do the loan at 160. If you don't use it, you can put that 10 grand back and just take the 150. It's a reserve, basically, account. Yeah. So like if plumbing, electrical, or someone cuts a line or something crazy that you just you have to get in there and fix, you can do that. So they have some contingency plans on those financing options, and they are a little more. There is a difference in the interest rate because it's a little more risky. So in financing for houses, the more risky it is, the more, like, the higher the interest rate is. So when you're doing new construction financing or renovation, it's not equal to the purchase rates if you're buying it like as standing, because you have all these things that have to happen in between to get you to the end. It's not bad, it's just different. It is higher. Sometimes you're just as happy at the end and you stay where you are. And on all of these things we've sort of touched on today, like David, when you were mentioning, like, if you have equity or you pay down your loan a lot or something, you can always refinance. So, you can refi to get out an FHA program, or you can refi to go to like a 20-year or 15-year loan. So your interest rate is lower, you're paying off your mortgage faster. So that's always an option out there. Or if you do new construction renovation, maybe after you're there a year or two and everything's settled, you can refi, out of that into something that's current, especially if the rates are better.
Yeah. Okay. And that's the name of the game then. So if you have a bunch of equity in there, you would refinance at the end once the job is completed and have that.
It's definitely an option. Yeah.
Savings. Yeah.
Sure.
I think that, I'm sure you're seeing a lot about affordability. Do you see any solution to that issue?
It's tough because people, sometimes you have to pull them in when they're doing their pre-approvals to the numbers they want. And then sometimes you're telling them, hey, you can go way up here. And they're like, oh no, I want to be here, which is fine too. Whatever you would like. If someone's trying to really, really stretch, I mean, we can look at different products with different rates or co-borrowers, different things like that. But, yeah, we're stretching the ratios, which leads back to if you're, trying to buy here whenever really the threshold's here. FHA is one of those programs that lets you stretch a little bit. So it could be another reason to use one loan program over another.
Oh.
Okay. Yeah, the biggest thing on the affordability that I'm hearing is they keep wanting to wait for more government products to come up, but you have to remember they come in the form of free money, and then they want to go and spend that money, which is then drives up the prices even higher. I
Right.
think the real solution is getting with a lender that's willing to get creative and figure out different solutions. But these renovation loans, we have a lot of an older population in Pittsburgh where you can
Yeah.
find properties that need a little bit of work, like old shag carpet. You see the pinks in the bathrooms, the lime greens. We Amber's company can lend that money to you. You can get it fixed to what your living standards are, and the profit is there at the end of the deal, and you got a house for much less than what it would have been turnkey.
Right. Yeah.
Really?
Yeah. Cassie,
Sure.
do you have anything on that?
No, I mean, I think one of, the biggest things that I always hear, because I do work with a lot of first-time home buyers, is they are just so, it's just things that they hear. So it could always just be like, I might not qualify. So now what, so I think like one of the biggest takeaways from today that I want people to understand is that there are so many different options out there. There's a lot of help that you can get, and it's not, don't give up. Amber, especially, if you're going to work with Amber, she's going to be there for you. We're going to be there for you. Like, there's a lot of options out there. So don't let it scare you out of your search.
Right.
Yeah. I want to do just a final quick couple questions here, like a 60-second answer on it. Okay.
Okay.
It can be like a rapid fire. Would you buy now or wait?
Buy now.
Biggest myth about the 20% down?
You don't have to put 20% down. There's from 3% to 19%. There's that many options for mortgage insurance in between.
Mm-hmm.
So
How about FHA versus conventional? Who should use this FHA?
FHA, great program. It can be speedy, and you shouldn't shy away from it. It's depending on your financial picture, we can compare it against conventional, see if you can qualify for both, and then kind of drill down as to which one's going to help you the most, depending on down payment and closing costs and those things.
Okay. Will rates drop this year?
Rates are slated to hold technically. So we're going to see a little bit of a window, but they're not going to the fours. We'll probably see them in the upper fives, and some programs are in the upper fives right now. But the forecasting is this is where they're going to remain. Like we're right around 6, just under.
Mm-hmm.
If you choose different products, I know we didn't really launch into fixed versus adjustable, but maybe some adjustable rates are lower. But I'm talking about fixed rates.
Okay.
Are you?
Since you brought it up, adjustable rate mortgages, are they smart or risky?
Depends how long you're planning on being in the house. So I had an adjustable rate that was like a 5-year fixed, and I kept that loan for 13 years because after my 5th year and it was adjusting, it was going down. So my rate was lower than it was where I began. So I kept it.
Okay.
So it just depends. They have usually a part where they're fixed. So if you think you're going to be somewhere for 5 years or 7 years, you're going to get a lower interest rate. It's a good option to think about.
Yeah. Great. What's the biggest mistake that you think buyers make?
Listening to everyone around them sometimes.
Yeah.
No, advice is always good, but sometimes people don't know all of the ins and outs. Like maybe they don't know everything about you that maybe a mortgage person might know, and so could be a good reason why we're doing something the way we're doing it.
Absolutely. Do you think buyers should get pre-approved before they begin their house hunting?
I do. It can't hurt, especially if you're not affecting the credit, then it'll give you a good path and you'll know a target. So if you're seeing what costs are going to be and you're good with it, then you know you're solid rather than doing it. I found this house and then getting like sticker shock. Oh, I didn't know it was going to cost this much. So I think it's good to kind of know those things before jumping in the pool, but
Yeah.
do with both.
Absolutely. And if someone wants to buy this year, what's the first thing they should know? Or first thing they should do? I'm sorry. Or
Buying this year,
Yeah.
I think what you just mentioned, like just working on a pre-approval, whether I've done a few already that their target is like end of summer, but they just, again, wanted to budget, know where payments are going to be. And then we'll actually be able to compare once they're getting closer. We'll see whether things have improved or stayed the same. And,
Absolutely.
Got you. Amber, thank you so much for coming on.
you're
Is there
welcome.
anything
Thank
final
you
you
for
want
having me.
to that you want to mention?
No, I appreciate this. This is like, I won't talk to you this long if you're getting a pre-approval. However, these are the paths that I take almost every person through when I'm pre-approving them, just to figure out like what options. And maybe it's not the very first time we talk, but over maybe the first couple times, and when you're looking at houses, like these are all the different sort of topics that get touched on a lot. So it's a good snapshot of how it goes with a pre-approval.
Yeah.
I mean,
and a ton we didn't talk about here. So guys,
sure.
we're gonna leave Amber her information for you guys to reach out to, because we could talk for 3 hours.
That is
Yeah.
true. Yeah. Wouldn't be able to talk by then, so no, I'm just kidding.
We'll save your voice
Amber,
for the buyer.
Can you tell us maybe a secret spot around the city and South Side that you highly recommend? I know it's not a secret after you tell us, but we really want to know somewhere good that we should go. Maybe anything.
I got Dish on 17th Street.
Dish on 17th Street.
It's very small, but I love going there. I love going to the bar. The food is awesome. You probably need a reservation, but yeah, love it there.
Yeah, I'll have to try
That
it.
is Dish Osteria Bar. Okay, cool.
Very nice.
Duke's Tires, man. Duke's Tires is right there on like 14th or 15th Street. If you ever need a tire, you can drive in there.
I was not expecting
There you
that. Duke's Tires.
Saved me a couple of times.
There you
That's
go.
cool.
Shout out to Duke.
So Amber, where can people reach out to you at? If they have questions.
I mean, I'll give you my email, but my cell phone, you can text me, call me, 724-316-6757. And even though my name is Amber Housholder, there's no E, so it's HOUSHOLDER. So my email is amber.householder@gravate.com. So don't be afraid to ask any questions.
Yeah.
All right.
That sounds great. Thank you so much.
Beautiful.
You.
Cool, guys. So if you got any questions, reach out to Amber, reach out to us if you have any questions as well. If you enjoyed this episode or have any questions you want us to cover on the next episode, send them our way. We love hearing from you guys.
Absolutely. That's going to do it for this week's episode of Move Me to Pittsburgh. Thanks for spending time with us.
Peace.
Bye.
Bye, guys.
Bye.